Episode number 6. Asymmetric Bets. How Sam Knew When to Risk $500 on Bitcoin. In 2011, Sam invested $500 in Bitcoin at $1.50. I invested $14,000 in horses. Sam's bet became $8 million. Mine lost $23,500. What's the difference between a smart asymmetric bet and a stupid gamble? In this episode, I break down the exact framework Sam used to evaluate Bitcoin and why my horse investment failed every single test. This is how you prepare for the next Bitcoin, whatever it is. Welcome back to The Prosperous Steward. I'm Rich Abbott. Today we're talking about asymmetric bets, the kind of investments where you risk a little and could gain a lot. Sam risked $500 on Bitcoin. I risked $14,000 on horses. Sam's upside was unlimited. Mine was capped at maybe 2 times if everything went perfectly. Sam could afford to lose his $500. I couldn't afford to lose my $14,000. Sam won. I lost. Let's talk about why. What is an asymmetric bet? An asymmetric bet is an investment where the potential upside is massively larger than the downside. You risk $500. You could make $500,000. That's asymmetric. You risk $10,000. You might make $15,000. That's not asymmetric. That's just regular investing. The key is the ratio. Downside is small and defined. Upside is large and potentially unlimited. Bitcoin in 2011 was the perfect asymmetric bet. Downside, $500 goes to zero. You lose $500. Upside, Bitcoin becomes what the early adopters thought it could become. You make millions. That's 10,000 times potential upside with capped downside. Sam understood this. I didn't. The 5-question framework. Sam didn't just throw $500 at Bitcoin because it sounded cool. He ran it through a framework. 5 questions. If he couldn't answer yes to all 5, he didn't invest. Here they are. Question 1. Do I understand the fundamental value proposition? Sam could explain in simple terms why Bitcoin should increase in value. Its digital scarcity, limited supply, solves the double spend problem, enables trustless transactions without banks. He didn't understand all the technical details, but he understood the core value proposition. I couldn't explain why Gypsy Vanner horses should increase in value beyond people pay a lot for them. That should have been a red flag. Question 2. Is it early enough that most people haven't noticed? In 2011, almost nobody had heard of Bitcoin. Tech nerds knew about it. Mainstream media called it a scam. That's early. Gypsy Vanner horses were already popular and expensive in 2011. I wasn't early. I was late to a saturated market. Question 3. Can I afford to lose this investment completely? Sam's net worth in 2011 was $93,000. His Bitcoin investment was $500. That's 0.54% of his net worth. If it went to zero, he'd be fine. My net worth in 2011 was around $50,000. My horse investment was $14,000 initially, plus ongoing costs. That's 28% of my net worth, and climbing. If it went to zero, which it basically did, I was in serious trouble. Sam passed this test. I failed it. Question 4. Is the potential upside 10 times or more? Bitcoin at $1.50 could realistically go to $15, $150, or higher if the technology worked. That's 10 times, 100 times, or more. My horses? Best case scenario, I sell foals for $5,000 each in 3 years. That's not even 2 times on my total investment. And it wasn't guaranteed. Sam passed. I failed. Question 5. Am I prepared to hold for 5 to 10 years? Sam had zero debt, low expenses, a $15,000 emergency fund. He could hold Bitcoin through crashes and volatility because he didn't need the money. I had debt, high expenses, no emergency fund. I needed income from the horses within 2 to 3 years, just to cover ongoing costs. When things went wrong, I had to sell at a loss because I couldn't afford to wait. Sam passed all 5 questions. I failed at least 4 of them. That's why Sam made $8 million, and I lost everything. The difference between asymmetric bets and gambling. Here's what most people get wrong. They think Bitcoin in 2011 was gambling. They think my horse investment was a safe business opportunity. It was the opposite. Bitcoin was a calculated asymmetric bet. Small risk, massive upside, fundamental value proposition, early timing. Horses were a desperate gamble. Large risk, small upside, saturated market, no edge. The difference? Asymmetric bets have 5 characteristics. You understand why it could work. You're early. Most people haven't noticed. You can afford to lose it completely. Upside is 10 times or more. You can hold for years without needing the money. Gambling has these characteristics. You don't really understand it. You just hope it works. You're late. Everyone's already talking about it. You're risking money you can't afford to lose. Upside is capped or unclear. You need returns quickly. I thought I was making a smart business decision. I was gambling. Sam looked like he was gambling. He was making a calculated asymmetric bet. Why most people take the wrong risks? Here's the painful truth. Most people, including me, take huge risks on things with small upside, and avoid small risks on things with huge upside. I risked $14,000 on horses, 28% of my net worth, for a possible 2 times return. I refused to risk $500 on Bitcoin, 1% of my net worth, for a possible 1,000 times return. Why? Because horses felt safe. I could see them, touch them. I understood them, or thought I did. Bitcoin felt risky, digital, intangible, weird. My brain lied to me about which was actually safer. This is why most people miss asymmetric opportunities. The ones that feel safe, real estate, businesses you understand, tangible assets, often have limited upside and high risk. The ones that feel risky, emerging technologies, new markets, things you don't fully understand, often have capped downside and unlimited upside. You have to train yourself to evaluate opportunities rationally, not emotionally. Sam's actual Bitcoin evaluation, May 2011. Let me show you Sam's actual thought process when he evaluated Bitcoin. He didn't write this down, but this is what he told me years later. Question 1. Do I understand it? It's digital scarcity, limited to 21 million coins, solves the double spend problem, enables peer-to-peer transactions without banks. I don't understand all the cryptography, but I understand the value proposition. Question 2. Is it early? Almost nobody's heard of it. Media calls it a scam. Only tech people know about it. Definitely early. Question 3. Can I afford to lose it? $500 is 0.54% of my net worth. I have $93,000 saved, 0 debt, and a $15,000 emergency fund. If this goes to 0, I'm completely fine. Question 4. Is upside 10x plus? If it works, it could easily be $15 per coin. That's 10 times. Could be $100 or more. Massive upside if the technology proves itself. Question 5. Can I hold 5 to 10 years? I don't need this money. I'm investing $650 per month in index funds. I have low expenses. I can hold this forever if needed. All 5 questions. Yes. Decision. Invest $500. My actual horse evaluation, May 2011. Here's my thought process. This is embarrassing, but it's the truth. Question 1. Do I understand it? Horses are valuable. People pay a lot for good horses. I think I can breed and sell them. I didn't understand the market, the breeding timeline, the actual demand. I just assumed it would work. Question 2. Is it early? Gypsy vanners are already popular and expensive. Not early, already saturated. Question 3. Can I afford to lose it? $14,000 is 28% of my net worth, plus ongoing costs for feed, vet, land, fencing. I couldn't afford to lose it. I needed it to work. Question 4. Is upside 10x plus? Best case, sell foals for $5,000 each in 3 years. Maybe $10,000 if they're really good. Not even 2 times, and not guaranteed. Question 5. Can I hold 5 to 10 years? I need income from this within 2 to 3 years to cover costs. I have debt, no emergency fund, can't afford to wait. Can't hold long-term. Needed quick returns. 0 out of 5 questions answered yes. I invested anyway. That's desperation, not strategy. The hierarchy of opportunity. Sam taught me there are 3 types of investment opportunities. Type 1, sure things, index funds, employer 401k match. Emergency fund, paying off high-interest debt. These are boring. They work. They compound slowly. You should do all of them. This is the foundation. 90% of your wealth building should be Type 1 opportunities. Type 2, asymmetric bets. Bitcoin in 2011. Early Amazon or Tesla stock. Startup equity if you have an edge. Real estate in emerging markets before everyone notices. These are rare. They require preparation. You need Type 1 solid before you take Type 2 risks. Maybe 10% of your wealth building should be Type 2 opportunities. 1 or 2 good ones can change your life. Type 3. Lottery tickets. Actual lottery tickets. Penny stocks. MLM schemes. Hot tips from friends. Meme stocks based on hype. These are designed to take your money. The house always wins. You should never do these. My horses were Type 3, disguised as Type 2. Sam's Bitcoin was Type 2 executed properly. Most people chase Type 3, ignore Type 1, and never get ready for Type 2. How to prepare for the next Bitcoin. Everyone asks, what's the next Bitcoin? Wrong question. The right question is, will I be ready when the next Bitcoin shows up? Sam was ready in 2011 because he had Type 1 handled, index funds, emergency fund, 0 debt, low expenses. He had capital available, $500 he could lose. He had emotional stability, could hold through crashes. He had a framework, the 5 questions. I wasn't ready because Type 1 was a mess. Debt, high expenses, no emergency fund. I had no capital. Everything was tied up or owed. I was emotionally desperate, needed quick wins. I had no framework, made emotional decisions. The next Bitcoin is coming. I don't know what it is. AI? Quantum computing? Longevity biotech? Something we haven't imagined yet? Doesn't matter. What matters is, will you be ready? The biblical principle. Some of you are thinking, isn't this just greed? Chasing get-rich-quick schemes? No. There's a difference between greed and stewardship. Greed says, I'll risk everything on a moonshot because I want to be rich fast. Stewardship says, I'll allocate a small portion to high upside opportunities after I've handled the fundamentals. Remember Joseph in Genesis? He stored grain during the 7 years of abundance, so there would be food during the 7 years of famine. That's preparation. That's stewardship. Sam stored wealth, type 1 investing, during his earning years. When the asymmetric opportunity showed up, Bitcoin, he was ready to take a small, calculated risk. I didn't store grain. I spent everything. When opportunity showed up, I was desperate and made a bad bet. Biblical stewardship isn't about avoiding risk. It's about being prepared to take smart risks when they appear. Your action plan. Here's how to prepare for asymmetric opportunities. Step 1. Get Type 1 handled. Emergency fund, 6 months expenses, 0 high-interest debt. Housing cost below 15% of income. Automatic investing in index funds. Don't even think about Type 2 opportunities until Type 1 is solid. Step 2. Set aside 2 to 5% for asymmetric bets. Once Type 1 is handled, allocate a small percentage of your net worth for Type 2 opportunities. 2 to 5% maximum. If it goes to 0, you're fine. If it 10 times, it changes your life. Step 3. Use the 5-question framework. Every time you see a hot opportunity, run it through the 5 questions. If you can't answer yes to all 5, don't invest. Step 4. Be patient. Real asymmetric opportunities are rare. You might only see 2 to 3 in a decade. That's fine. You only need to be right once. Step 5. Hold. If you take an asymmetric bet and it starts working, the hardest part is holding. Bitcoin went from $1.50 to $30, then crashed to $2. Most people sold. Sam held. That's why he won. The real lesson. Sam didn't get rich because he got lucky with Bitcoin. He got rich because he was prepared when Bitcoin showed up. He had capital available, 0 debt, low expenses, emotional stability, a framework for evaluation, the discipline to hold. I had none of those things. So when opportunity knocked, Sam answered. I couldn't even hear it over the noise of my financial chaos. The next asymmetric opportunity is coming. Be ready. Let's review. That's asymmetric bets. Sam risked $500 he could afford to lose on something with unlimited upside. I risked $14,000 I couldn't afford to lose on something with capped upside. Sam won. I lost. The difference wasn't luck. It was preparation. Next week, we're talking about how Sam held Bitcoin through a 93% crash without selling. The psychology of conviction. Until then, get your Type 1 opportunities handled. Build the foundation. Then you'll be ready when Type 2 shows up. I'm Rich Abbott. This is the Prosperous Steward. Head over to richabbott.com/resources for the free asymmetric bet evaluation worksheet and other wealth-building tools.